What does your annual income in retirement look like? Take that number and divide it by 4%, and you get your necessary savings that, according to the original Trinity University study on safe withdrawal rates, should last you anywhere between 25 and 30 years. But will it really? Hi, I'm Alex Wolf, Head of Financial Planning at Base Wealth Management, and today we're diving into the 4% withdrawal rule and figuring out why it might not be that golden ticket to a comfortable retirement. The 4% rule is straightforward and awfully strict. You take 4% out of your initial nest egg each year, year after year, until it runs out. But there are some major issues with this. First, we have the most obvious issue. Especially if you retire early, there's a great chance that you'll live much longer than 25 to 30 years after retirement. You can get around this by just pulling out 3% each year, right? Well, maybe, if you have enough saved up. But not everyone has that luxury. Second, we need to factor in volatility. A negative sequence of returns early in retirement can really hit your savings hard. If that's the case, you're going to run out of money a lot sooner than you thought. A $1 million savings account hit by a market loss of, say, 48%, like what happened between 2008 and 2009 with the S&P 500, is always a potential scenario. And you want then to remove 4% of what's left? It's no longer a bad day, it's a disaster. But you did the right thing. You shifted away from stocks and into bonds as you reached retirement age. Again, that could be a big problem. The thing is, bond interest rates today are significantly lower than in the original 4% rule study. And those higher bond rates of 40 years ago helped a lot more to cushion negative returns. Not anymore. A low interest rate itself wouldn't be a problem, but there's an elephant in the room we haven't discussed yet. But before we get into that elephant, I want to ask you to subscribe to our YouTube channel, especially if you've been tuning into our content and find it useful. So back to that elephant, inflation, the silent savings killer. It can often outpace your return rates, especially if you're primarily invested in bonds. Remember 2022's 9% inflation rates? Stocks had a hard time keeping up. Bonds didn't have a chance. Bonds are supposed to provide stability, right? So we need to stay invested in the stock market to outpace inflation. But that leaves us overexposed potentially to market volatility. How is this handled? Well, the answer isn't to cling to the 4% rule. It's way too rigid to deal with inflation, market returns, interest rates, and taxes all on its own. Now, all of this becomes even more crucial if you decide to take the bold step to retire early. Then you're looking at a whole bunch of other issues like health insurance, early withdrawal penalties, and Social Security. You can watch our video on retiring early by clicking here on the video to the left. So, what is the solution to the 4% rule? It's about having a plan that adapts to market conditions and your personal circumstances. It's about having a very clear understanding of what your income requirements will look like in retirement and building a withdrawal plan around that. It's about sitting down with a fiduciary financial advisor or planner and crafting a comprehensive financial plan that's tailored to you. We hope you learned something new in this video, and if you haven't yet, please hit the subscribe button. You don't want to miss out on our further financial insights that will help shape your retirement, and it will mean a lot to us. I'm Alex Wolf, and at Base Wealth Management, we're here to build the foundation for your financial plan. Feel free to schedule a call or a meeting by clicking on the link below.